Okay, good morning everybody and welcome to Bishop Fleming's Care Homes webinar with our guest speakers today from Christie & Co and Lloyds Withy King. We have 143 of you booked on to join us today, so that's a fantastic number and we welcome you all. My name's Tim Godfrey, I'm the Head of Healthcare for Bishop Fleming, and our webinar today will focus on how our experts see the market and the transactional outlook for operators across the South and South East areas. That said, the content, I know there's a few of you who've joined us from out of that area, and whilst the content might be geographically specific, I'm sure some of it will still be very relevant to you. The agenda for today is we're going to talk for about 45 minutes or so on various aspects that per the invite, questions and answers at the end. I'll be starting and introducing Charles Phillips from Christie & Co. Charles is a director in the southern region of Christie & Co, and he'll give us a market overview. He'll pass the baton to Hazel Phillips, who I don't think is a relative, but I've not asked the question. And Hazel is head of health. No, she's shaking her head at me here on the screen. Hazel is head of health and social care at Lloyds Withy King, and Hazel will be telling us all about selling or buying during and post-pandemic, and dealing with some of the issues she's seen and opportunities. My colleague Charles Davey will then talk a bit about funding and bank appetite a year on, and Charles is joining us from our corporate finance team. And then finally we'll hand the baton to John Harrison, a director at Christie & Co covering the southeast of England, who will probably keep you all enthralled with his version of valuations and what your business is worth at this point in time and potentially in the next few months and years anyway. We'll finish with a question and answer session. Questions will be taken at the end, and you've got an opportunity to ask us questions using the live Q&A buttons on your screen. You can post these anonymously if you don't want to be identified. If you're really brave, you can give us your name and we'll be able to answer you specifically back, and we'll choose the right person to answer the questions as we get to that. So we'll try to answer as many questions as possible. If we don't get to answer your question during the live session, then we will respond to you afterwards. There will be some resources and documents that we'll share after the event, and the webinar is being recorded, so it will be available to watch back for those of you who couldn't join us today, and for us just to see how well or badly we did, of course. So we're going to push on through and get through some of the topics I know you want to hear about. So as I said, my name is Tim Godfrey, and I'm just going to give you a little bit of a view from an accountant's perspective. Operationally, I think over the last 12 months, so they've been challenging to say the least. The sector has worked hard to deal with some of the challenges it's come across. Normally very good at dealing with viruses, but of course the coronavirus was a completely new animal. COVID-19, as we all know it, brought major challenges, not least the lack of PPE and the impact this had on residents and of course staff safety. Operators stepped up, we know that, and locked down early. You know, you source your own PPE and often at some extortionate prices, but you introduce new protocols which increased pressure on the staff and those who worked long hours and often cases had to sleep on the premises. I think as a consequence of the first lockdown, most of the transactions that hadn't completed by late February, early March 2020 were put on the back burner. Both operators hunkered down and banks took a more cautious view on lending. If we look back a year ago as accountants, most of our work at that time was with our clients, looking at how they would get through this, talking to them about the financial support packages, looking at business bounce-back loans, coronavirus business interruption loan schemes, and generally chatting through with their funders about, you know, capital repayment holidays and just making sure they could get through those operational challenges. On top of this, of course, we have the government grants, and specifically for the sector and those more widely available like furlough. From a financial reporting perspective and a transactional perspective, operators need to ensure as we move forward that they account for the income received in the correct accounting period and ensure that the evidential audit trail is available to provide for buyers as we look to go forward. Transactional funding, I think now, except in exceptional cases, have dried up, but Charles will talk a bit more about that from our corporate finance team on how it's looking now as we go through. Already on a digital journey, this pandemic accelerated the adoption of technology, both in the care home setting, for communication with relatives and staff, but also for the adoption of cloud-based finance systems that we've been using and implementing for our clients. Overnight, I just clicked on there too far. Overnight, our conversations with clients moved predominantly from face-to-face or telephone to video calls. And we see that continuing, although I think a lot of us are looking forward to getting back out on the road and meeting real people. With the vaccine rollout and the new pandemic recovery plan in place, we're looking forward to some normality over the summer, but it's likely to be a bumpy ride, we think. So I'm going to circle back to transactions now. These have continued, as you can imagine, throughout, but with a host of challenges for both buyers and sellers. Deals have completed, and certainly in 2021, we've seen activity in the market increase significantly, and I know that the other speakers will talk more about that, especially the guys from Christie's. Inevitably, deals do take longer, and that has become increasingly clear that those that prepare for the sale or the purchase are more likely to get what they're looking for and to meet the proposed timetable, which rather leads me nicely into introducing our guest speakers for today. So I'm going to hand over now to Charles Phillips, and Charles is going to talk about how the pandemic has impacted our operators in his region, and then Charles will hand on, as I said before, to Hazel, etc. So Charles, over to you.
I'm going to talk now for a few minutes around transactional market. We all know that the UK care home market remains fragmented, with around 80% of provisions supplied by the private sector, and this is one of the reasons why it attracts so much investor interest. There are around 12,500 care homes in the UK and 1,827 in the South East, representing around 14.6% of the national market. The South East has around 74,700 bed spaces, and this is a key economic driver of the region. Of these beds, there are 72,400 actual bedrooms, and of these 55,960 are of effective market capacity, i.e. single ensuite rooms. Our analysis suggests that the average size care home in the UK is 40 beds. Whilst the demand for elderly care has increased dramatically in recent times, there has actually been a reduction in the number of care homes in the South East over the past 5 years, with over 290 care home closures. During this period, there have been 261 newly registered care homes come online. These newer purpose-built settings tend to be larger than those closed and offer better configuration and facilities. In 2015, the South East, there were 1,861 care homes, and in 2021, this is reduced to 1,827. Pre-COVID, our analysis shows that the average occupancy in the South East was around 92%, which is slightly higher than the national average. Whilst this morning's discussion is not focused on COVID, I thought it would be useful to analyse the impact of the care homes in the region. This has been a very challenging time for care homes, with many of our areas being hit quite hard. However, there have been massive variances in the region, with Kent being hit hard and the Isle of Wight not being quite so adversely affected. While numbers are reducing dramatically throughout the UK, deaths are still occurring. However, with the mass vaccination programmes, this hopefully will fall even further. For the week ending the 9th of April 2021, the CQC data shows that in Hampshire, there's only one COVID-related care home death, but in the week of the 17th of April 2020, the highest number recorded in the county was 89. In West Sussex, there were no COVID-related deaths, with the highest number seen during the week of the 29th of January 2021 at 72. In East Sussex, there were no COVID-related deaths, with the highest number being reported of 81 during the week of the 22nd of January 2021. In Kent, there were 2 COVID-related deaths, with the highest figure of 107 seen during the week of the 8th of January 2021. And finally, in Surrey, there were 2 COVID-related deaths, with the highest figure of 107 being reported for the week during 22nd of January 2021. It is clearly very difficult to determine exactly why some areas suffered proportionally more deaths than others. There are many factors at play, but with lockdowns, testings, and vaccinations, care home owners have done what they can to look after their residents and staff as safely as possible. Clearly, we're not out of the woods yet. Many operators I'm speaking to in the region are worried about the easing of lockdown, and whilst it is a relief to residents and their families, that visits to care homes can now take place, this does open up potential of the virus being brought into care homes, even though testing is being carried out pre-people going in. With the easing of the national lockdown, will there be a third wave at some point? So what does this all mean for the market? Well, I think the overall message we have for you is probably more positive than many would expect. Understandably, activity in April 2020 was very subdued, but in June and July 2020, there was increased engagement from both buyers and sellers. Encouragingly, inquiry levels are now almost on a par with the pre-first lockdown numbers. To illustrate this, we've analysed activity for the first quarter of 2021, compared with the same period for 2020. In the first quarter of this year, we are only 7% down on the number of offers received compared to the same period last year. Care home deals agreed for the first quarter of 2021 are down only 3 on last year, but the aggregate value of these is greater. During 2020, Christie & Co sold 148 care homes. This number is down compared to 2019, but for perhaps hardest trading period we have all known, these sales demonstrate that the care homes were and are still in great demand from applicants. The slight issue we have at present is getting new stock on the market. There are buyers out there waiting for new opportunities. So in general, the market is still functioning and the activity in the southeast very much reflects the national picture, with some pent-up demand from investors and operators. Homes of all sizes and categories of care are selling, with a recent completion being Saxby Lodge in West Sussex, which is a 19 registered elderly care home and was sold to an existing local care home operator. There's been some debate about how the pandemic will shape the care home market. During the first lockdown, we saw increased investor appetite for home care businesses. With a greater number of people working from home, they have the flexibility to help and care for their parents, and there's been a reluctance to consider a care home option, given the settings have been in lockdown. Anecdotally, we are hearing of occupancy rates having dropped from 92% down to 70-75%, and in some cases even lower. I don't see this being a long-term trend, but one of the key questions is how long it will take for the self-funded market to rebound. We are now seeing many clients experiencing a greater number of local authority referrals, and occupancy is building once again in many homes. Demand is still very strong from buyers for care homes at present, as we said, and this will only increase. There is no doubt that there will be a greater flight to quality in terms of spatial standards moving forward. Larger single bedrooms with wet rooms will be even more appealing for purchasers and also residents' families moving forward. Unfortunately, many operators have been hit hard, and we are likely to see a greater level of distress in the sector. The various government-backed loans are likely to help providers in the short term, but the supply of available care homes is likely to increase towards the middle of the year. The number of larger national operators have been hit hard, with occupancy suffering, with many now trading at around 70-75% occupancy as well. These companies will be reassessing their portfolios, and we are likely to see a number of disposal programs shortly. These assets will provide local operators with a good opportunity to grow their portfolios. An example of this is the 52 HC1 care homes that Christie & Co have been instructed to market, and these will be coming to the market very shortly. So that ends my whistle-stop tour of the market currently, and I look forward to answering any questions shortly. Thank you very much, and I will hand you over to Hazel.
Thanks very much, Charles. For those of you that don't know me, my name is Hazel Phillips. I'm a partner and head of health and social care at Royds Withy King. We're a top 100 firm that specialises in advice to care providers across all aspects of running care businesses. And my particular specialism is advising on sales and acquisitions in the sector. So just looking back at how COVID has changed the transaction outlook, I'm always asked how quickly deals can be done. And estimating how long a deal will take is always really tricky, as buyers and sellers can have different ideas of what they want to achieve, with various factors derailing the best of intentions. For example, an unprepared seller, obtaining CQC registration where you've got an asset deal, difficulties for buyers in obtaining funding, and sometimes lack of commerciality in the approach to negotiations. Since sort of April last year, the quicker deals we've been involved in have had private equity backing or REIT backing, and we've certainly seen longer lead times between acceptance of offers and buyers having their finance ready, particularly where banks are lending. The bank lending is starting to come back. On the whole, banks are requiring more information to satisfy themselves that the target is a good basis for secure lending. And it's really important that both parties factor that into their expectations to avoid frustrations boiling over at a later date. And equally important that sellers can provide good quality financial and occupancy figures from the outset. For the last year, there have been obvious difficulties in allowing buyers and their teams into homes to carry out property-based and operational due diligence, and that's often led to an increase in this sort of inquiries going through lawyers to resolve. And we do recommend that where sellers are comfortable to do so, they deal with operational questions directly with the buyer or via agents. So this can be run in parallel with the legal process. That can really help speed things up and avoid any last minute site visits, which can throw problems up right at the end. Buyers can really help themselves complete quickly by organising and communicating their due diligence programme, ensuring the seller's aware of any requests for on-site visits and access to key personnel. Especially on some of the larger transactions we're involved with, the buy-side team often produces several streams of inquiries from different sources: financial, tax, operational, legal, HR, and they're often sent in stages and overlap, and that can create a real burden for sellers, particularly where you're trying to manage businesses in quite a difficult climate. So streamlining that from the buy side is really important and can help with a quicker completion. So in terms of due diligence, excuse me, what's changed? As you might expect, buyers and to an extent investors and lenders have continued to focus in on occupancy rates and funding, especially the use of infection control grants and so on. For a period last summer, due diligence was very centred on PPE testing and COVID guidance, and that, as you might expect, has dropped away a bit. With the success of the vaccination programme, due diligence is more focused on some of the longer term risks and potential liabilities, such as use of the furlough scheme, shielding, and in particular adequacy of insurance policies. And certainly we're seeing buyers want to communicate with insurance brokers on the sale side, because it's not always obvious from reviewing insurance policies what actually they cover. And certainly as legal advisors, we don't touch them. It's such a specialist area. As always, buyers want to see a complete set of maintenance certificates and health and safety risk assessments. And we found that some prospective sellers are not up to date with those because they've understandably been reluctant to allow contractors on site. But I think if you are going to market, you need to find a way around that to avoid buyers losing confidence during the process. It was certainly a relief from my point of view, and I'm sure it was for many of you, that the MENCAP case on sleep-ins was unaltered by the recent Supreme Court ruling that has made negotiations much simpler on deals where sleep-ins was an issue, and has taken away the need for indemnities and retentions on that point. And finally, how have contract terms changed? I anticipated last year we wouldn't see wholesale changes to contract terms, but we have seen the introduction of some specific warranties and indemnities covering COVID issues. So, for example, the coronavirus job retention scheme has come into the tax covenant on share deals, and there's also been some cover on infection control fund and potential clawback on that. The advice I always give is, especially if you're on a share sale, you do use specialist accountants. It's really important that the specific accounting policies are carefully dealt with to ensure that neither side lose out, and you need a sector specialist to cover that. Today, we're often asked about retentions. Is that a norm? Do we see much of them? That is such a deal specific issue. We don't particularly see a norm on the larger transactions, so the sort of 5 million plus. They're more usual, and particularly if you've got a REIT or a big corporate buyer, you can expect a retention. But the amount and the duration is always up for negotiation and does vary. So that was hopefully a snapshot of some of the sort of ongoing legal issues of transactions. And I'm going to hand over to Charles Davey of Bishop Fleming, who's going to talk about funding challenges. Thank you.
Thanks, Hazel. Good morning, everyone. As Tim mentioned, I'm a corporate finance partner, but I also lead the funding sector here at Bishop Fleming. For those of you that remember me from a previous healthcare webinar, you'll be pleased to see that I'm not delivering this one from the back of my car. Just before I go into what I talk about, we do have the Q&A part here. So if any of you are thinking of some questions, please fire those in. We've got a few coming in, but if we could get a bit more, that'd be great for the Q&A after we finish. So onto the healthcare funding market. And overall, following the challenges of 2020, I'm pleased to report that actually the funding market is again getting pretty active. Maybe not fully unlocked, but I think it is certainly unlocking. And I do think it's right to pass a general comment, and some may disagree with me, but I think that in the past year and on the whole, the banks did do a pretty good job of delivering government support through C-bills and the Bounceback loans. And actually even better, after much lobbying, following quite a lot of concern early on, we did manage to get the banks to remove this available security need as a key criteria. And so there are actually many care home businesses that did actually raise C-bills facilities alongside restructuring and reterming existing debt, which actually provided that much needed cash flow headroom just to support the challenges of the trade that the pandemic brought. But remember that many of those facilities are now starting to reach their first year anniversary, and so repayments and interests are about to commence. The good news though, and I've seen this in a number of cases, is that many restructures have resulted in the cash cost of debt being similar now to the pre-pandemic level, even though the total debt position has grown in the business. However, as a corporate finance partner, it would be remiss of me not to mention that as a downside point, if the company did take on debt during the pandemic, it may affect the overall cash to the shareholders should the business be sold. Yes, the business will have its value, but that value will always be adjusted for cash in the business, but also any debt in the business, which will use to arrive at the amount the shareholders will receive on the sale. So if your debt position has increased, the equity in the business may well have reduced. Something just to watch for if planning to sell. Healthcare funding, though, like the wider market, continues to see much change. There's new funders appearing regularly in the market. We've got over 300 banking licenses alone in the UK. And this is in addition to quite a few private equity and REITs providing that equity and investment capital. The big five banks continue to have a pretty selective appetite as they deal with sector concentration risks and overall capital positions of their own balance sheet following the pandemic. And I think that's going to present for quite a while yet. But the good news is that the wider debt funding market has quite a strong appetite. These don't have the same constraints as a traditional banking model. And what we're seeing is a real appetite to grow portfolios in the healthcare space. And in the recent past, I'll admit, I've seen a few deals where the funder is certainly not a household name. I had to look a couple of them up on Google. The challenges and requirements, and Hazel mentioned this around on just general deals getting done, but the challenges and requirements of raising finance has not altered. And actually, I would suggest that overall the scrutiny has increased. And my gut feel is it's only going to get more. Now, good quality management information, the plan, financial projections, decent key performance indicators are all necessary to ensure a smooth fundraising process. Nothing new here, I hear you say, but it still amazes me how many businesses still approach funding in a totally unprepared manner. Those days of shouting at the bank manager to get your funding, or threatening to go to 3 different funders to negotiate the best deal, I think those days are quite gone. It's all about being prepared. And when equity features or REITs features, that level of preparedness has to increase. Investors are focused on return, and so they want to be confident that the value they are buying in at is actually supported by the numbers. Their focus is ultimately on the quality of reported and the future EBITDA. And just on that, we are being asked by equity funders to undertake pretty robust financial due diligence on their targets, which for some is rather challenging. So being prepared with long-term good financial and non-financial data is crucial if embarking on the equity route. And finally, just a quick comment on the recovery loan scheme. This is the new scheme announced by the Chancellor in the budget. It's an offshoot, the child of the CBILS scheme. It's sort of planned to run through to Christmas, but my fear, especially around the healthcare market, is it's much more traditional and mainstream. It feels a bit like the old enterprise finance guarantee scheme. It's interest in capital paying by the company from the start, and although the interest margin is capped at a healthy 15%, it is basically down to the lender to set the pricing. You can borrow up to 10 million, and it's over a period of 6 years, with no personal guarantees below 250 grand. So I think the scheme, my gut feel is the scheme will sit within existing bank assessment criteria. So if you meet all the criteria of the bank that it would lend to you, but it wouldn't because of a lack of security, then I think that scheme will be used. So this could actually be helpful for those sort of care businesses that don't have assets, maybe home cares, maybe some of the sort of care technology businesses. But for a business with a care home in it, I doubt this will be much use at all, because traditional lending of secured mortgages using existing security is probably more appropriate to the business. So to wrap up, the funding market is unlocked. It's pretty busy, and I think this can only be a good thing for the sector. And knowing that a key component of funding will always be the valuation, I shall now hand over to John. Thank you.
Thank you, Charles. Great to hear such positivity on the funding front, and I'd just now like to talk about valuations. My name is John Harrison. I'm Director of Christie & Co, covering the southeast of England, and in terms of valuations, it's a question we're being asked a lot about at the moment, as I'm sure you can imagine. 3 points I'd like to cover this morning. The first is what sort of current valuation activity are we seeing? The second is what factors are being considered with valuations at present? And finally, how do values compare now with pre-pandemic? So to start off with current market activity, we've seen that the market has gathered pace, as has already been highlighted, and with the care sector still attracting strong interest, we're seeing a lot more clarity on valuations than we were at earlier stage of the lockdown, when unsurprisingly red book valuations came to an abrupt halt. Banks are re-emerging and issuing instructions for new lending and refinance valuations. And to illustrate this, so far we've been instructed on 160 care valuations in 2021 and 405 since the lockdown began. This has been new territory for us all, and the same applies to valuers. But we now have much more activity to be able to provide feedback about. Care businesses are valued on their trading performance, and therefore the million-dollar question, if you excuse the pun, is whether a care business is being valued at the same level now as it was before the pandemic started or not. In order to answer this question, there are 2 important factors to consider. The first is, has the trading performance of the business changed during the pandemic? And the second is, have market values for care homes changed during this period? In looking at the first factor, it's best to look at monthly occupancy levels and fee income for the care business over the last 12 months to measure if the trading performance has changed when compared to previous year's accounts. Where occupancy has taken a hit, there will need to be an assessment by the valuer on how long it will take for occupancy to recover to normal mature levels of fair maintainable trade versus the current trade assessment, and how robust the business was before the pandemic started. In making this judgment, factors to consider will be historic occupancy performance, an analysis of the supply of bed spaces in the area, the level of self-funded clients, how much marketing has been carried out, CQC rating, etc. If the valuer judges that, for example, it will take 6 months for the care home to recover occupancy levels to achieve fair maintainable trade, then the valuation will reflect this, and there will be a discount applied for the time it will take to achieve this level, together with the associated risks with it. We're also mindful as to how long care home transactions can take and want to avoid a sale valuation being adversely affected if occupancy will return to normal levels by the time the sale goes through. Although with specialists, solicitors, accountants and agents, this time can of course be reduced. It's interesting to note the following 3 relevant quotes which are currently appearing in valuation reports, which covers this as well. The first quote currently appearing is, "Our opinions of fair maintainable trade and fair maintainable operating profit are forward-looking trading positions that a reasonably efficient operator should be capable of achieving at a future point in time, when the coronavirus and its various adverse effects have passed and the operational performance of the business has reverted to its natural level." The second quote is, "It is hoped and reasonably assumed that the presence of the coronavirus in the UK will only be temporary. Our assessment of fair maintainable trade and fair maintainable operating profit, as stated in this report, has been completed on this assumption, and that any deteriorated trading performance will recover within a reasonable time frame." And the third quote is, "Where businesses have been affected by coronavirus, we have provided our opinion of fair maintainable trade and fair maintainable operating profit using reasonable endeavours and valuer judgment, considering a future point in time, assuming the worst of the coronavirus has passed, when trading performance has resumed and the business has recovered to a material extent. Please note that the business may well be performing at lower levels." So from these 3 quotes, we can see that valuers are looking at what the fair maintainable trade is versus the current trade assessment, and how long it will take to get back to the fair maintainable trade level, rather than just assess the value on the current trade assessment, which could well be lower because of the pandemic. Looking at the second factor as to whether market values have changed during the pandemic, it's sensible to look at how a business trading broadly the same now as it was before the pandemic is being valued. Valuation of care homes is underpinned by comparable evidence of the deals we're agreeing and those we've already concluded, and this helps us frame discussions with valuers around profit multiples and where values sit currently. Having both sales and valuation divisions at Christie & Co enables us to be well placed to demonstrate this comparable evidence and current market sentiment both swiftly and first hand. At present, we're seeing similar profit multiples of valuation being used now as we were before the pandemic started, and they've also been relatively consistent for a long period before this. So a business performing at similar levels now as it was before the pandemic started will be valued at a broadly similar level. We're also seeing demand for closed care homes from a variety of different buyers, including supported living operators, specialist care providers and residential developers, although the location, particularly the proximity to the M25 and the investment required, have a large influence on the value. But this demand has helped keep the values of closed homes in valuation reports stable. The new build development market, which we also have a specialist division for, appears to have been largely unaffected by the pandemic, once again reflecting the strong continued investment in the sector. Yields remain strong, and we've exchanged contracts on care development sites with circa 1,000 beds since the lockdown began. The care funding market tightened last year, and bank appetite in the sector and other investment will be one of the determining factors in business values in the medium to long term, although the number of valuations we're currently doing suggests this is improving, as Charles has alluded to as well. I'd now like to hand you back to Tim for the question and answer session.
Thanks, John. That was great, and thanks everybody else as well. I know we had a few sound problems with Charles Phillips' initial presentation, and as we've said in the answer to the questions and comments, we will make sure that Charles's script is made available to all of you after we finish. So we've got some questions and answers. Thank you very much to you, those of you that put them through, and we'll crack on with those straight away. And actually, I'm going to hand probably straight back to John, actually, who's turned his mic off now. With the first question is, are government COVID-19 grants and PPE payments taken into account in valuations? John, what's your view on that one?
Thank you, Tim, for that question. Yes, it's a very good question. I think the overall view from valuers is that these grants and payments are one-offs and aren't going to continue in the future, and therefore a fair maintainable level of trade won't be affected by these. So generally speaking, the grants and the payments that have been made available for a specific purpose, and that relates to the cost involved in operating the business during the current pandemic. So in the future, that they're not something which is going to be relevant and therefore aren't taken into account. However, the only caveat I would say about that is that if the government grants and payments are made to reflect the fact that bedrooms aren't currently being able to be used for a variety of different reasons because of the pandemic, then that will be taken into account, because effectively the occupancy will be lower. But if a bed is being used for an alternative purpose but is being funded by the grants and PPE payment, then that would certainly be taken into account in the valuation. Okay,
thanks, John. I don't think you can hear me. Hopefully you can. Appreciate that. Okay, now another question here, probably one for you, Charles. Actually, my Charles, that is. How do I access the repayment extension period on the CBILS loan?
Thanks, Tim. I've not been referred to as my Charles before, but I guess we've still got on here.
Sorry about that.
How do I access CBILS? So there's a lot of talk about this in the previous budgets. So Bounceback can be extended to 10 years, and it's pretty much a self-select process. On CBILS, yes, they can be extended, or the headline is they can be extended to 10 years, but actually most banks are, I think actually in the rules, it's around forbearance. So the banks aren't actually very clear at defining what each bank's forbearance period is, process is, but it is if the company is in a form of distress, it is likely to get that extension. So I think for most, it's going to be the 5 years plus the 1 year capital free. And then if there's a problem, that's when the bank may consider extending it out, is what I'm hearing at the moment.
Okay, thanks, Charles. That's great. I think we've got one now for Hazel. Hazel, is there any evidence that buyers are looking for a minimum percentage of care staff being vaccinated, given the potential future implications?
It's a good question as well. I have not seen that asked yet. That this is the sort of question I would put in the operational due diligence category, and I'd probably hope it didn't form the legal due diligence anyway. If I'm advising buyers, I tend to try and get them to think about why they need to know the answer to a question. And I guess the reason for that would be because it may carry potential risk and potential implications on occupancy, if that risk manifests itself in COVID infections. So I guess a buyer would be wanting to assess that as part of the bigger picture, but I haven't seen it asked yet, and it's not on my list of inquiries either. So I suppose time will tell as to whether it forms part of that. I understand the sector's quite sort of the response is quite mixed in the sector anyway as to whether that should be mandatory or not. So it'll be interesting to see where it goes.
Okay, thanks, Hazel. Another one around banking for Charles. Charles, the big banks were mentioned as cautious lenders into the market. Are there any other good, brackets, exclamation mark, smaller banks which are active in the care sector?
It's a good question. I think I think from a clearing bank, I think what we've got to differentiate between here is the big banks and the clearers. So there are smaller banks which are traditional banks. Are they any more active with appetite than the big five? Possibly, but possibly not. And you know, so that relationship side may well need to remain with the bank that you're with. But what we are seeing are these debt funds and these debt businesses that are not funded by deposits over the counter. They are funded by institutional money, and they have a lot more appetite to fund. But they are not a relationship bank. They are not the person who's going to turn up and you know, do all the other bits. They are very much focused on the transaction of funding your home, which is kind of what you need the bank for. But it's, if you're looking for that relationship, it's a slightly different model with those guys.
Okay, thanks, Charles. And I think we flip. I must say my Charles next time, because I think we immediately went to Charles Phillips there, who clearly isn't my Charles. No disrespect, Charles. And we got the wrong person, so there's a voiceover for Charles Phillips there. Okay. So probably one. Let me have a look at this one here. When negotiating a sale, how are central costs, head office and senior management costs dealt with for EBITDA purposes? So a question there about how do we adjust above or below the line for those? And I guess, Charles, from a corporate finance point of view, you must get asked these questions when looking at valuations of a business quite a lot.
Which one?
Yeah, I said corporate finance, Charles. That's you this time.
Yeah, I think that's a good. It's a good question. It depends on the buyer. So if the buyer is a larger corporate, they are more focused on the operating, trading profit of the care home, because, you know, frankly, if they make that acquisition, it is highly probable they will take those costs out via integration. So they may discount a number of those head office and senior management costs if they can replace them. However, if it's an investor or a smaller buyer and they need to replicate a lot of that cost and carry that cost, they will factor those in. So it depends on the buyer, and it depends a lot on what those costs are as well. We do see, you know, certain, you know, I see instances where we try and discount senior management costs and sort of take out £300,000 worth of salaries, but then when you look at it, there's not actually a management team left behind to run the business. So, you know, it will depend on what those costs are as well.
Okay, okay, another question coming in here. No, I've just picked up. Sorry, I'm picking up another one. A question from Rahul. Is there any evidence of a larger number of turnaround opportunities coming on the market as a result of the impact on COVID? That could be one, I guess, one of you guys from Christie & Co. Charles Phillips, have you seen any evidence of turnaround opportunities in the market?
Yes, I think there's going to be a number of distressed homes coming to the market in the next sort of few months. And as we're saying, a number of homes have been adversely affected by occupancy. Costs have still been the same, so profitability has sort of been reducing. So no, I think there will be a number of distressed homes coming to the market soon. Some of those will be smaller, older style homes, and there are one or two sort of slightly larger ones that we are talking to. So I certainly expect in the next sort of next 3 to 6 months there will be more distressed things coming to the market. I think certainly from the bank's point of view and IP's point of view, it hasn't been the right time to force or encourage distressed sales or putting businesses into administration. So now we're getting out the other side. I think I say there probably will be.
Okay, that's lovely. Thanks for that. There is a question here on what about the LD market? Obviously, we've been talking a lot about elderly care here. I don't know if anyone puts their hand up just to give a brief comment on whether I think Charles again, lovely, that's Charles Phillips, please.
Yeah, okay. Certainly at the moment, I mean, the LD sector is one that hasn't been sort of too adversely affected with COVID, obviously, because most of the residents are younger, more ambulant, and certainly, yeah, we are seeing those LD specialist homes, LD and supported living homes, being in great demand from buyers at the moment. Prices have held up well. The homes are profitable. As I said, yeah, most of the residents are younger and fitter, yeah, it's an extremely good sector really. Yeah, there's definitely buyers out there just trying to find the right opportunities. It's just trying to get the right stock. But no, definitely, LD sector is very good. Multiples have held up very well.
Okay, lovely. Thanks, Charles. John, actually one on valuations for you here. Are you seeing values of homes responding equally across all the regions of the UK as a result of the pandemic, or is there a particular region holding up better or worse?
Okay, yeah, it's a good question. I think we've always found, and I'm just saying this because I'm based in the southeast, but we've always found that demand for care homes in the southeast has been stronger, particularly as a lot of our investors seem to be based in or around the M25. Having said that, I think in terms of the demand overall, as I'd call him my Charles, but Charles Phillips is probably more professional. As Charles alluded to earlier, there is a shortage of properties generally available in terms of care home businesses, and therefore, really, we've found that the demand has been pretty strong right across the country. And in fact, in some areas where property values perhaps are a bit lower, people are able to get a good return, and therefore those properties have been sort of more in demand perhaps than areas of the southeast where you'd be struggling to perhaps find the same home for a similar price. So overall, it's really down to the strength of the business really in terms of where the demand is, but I wouldn't say there's a particular area which is stronger than another. It's really based on the business itself. Okay.
Lovely, thanks, John. And there is a little one here. General comment: is there still lender appetite for homes with less than 20 beds? Which I think is a good question, and in my experience, it's becoming more challenging, and some of the mainstream banks are pulling out. Charles, Davey, I don't know if you've got any comment around that from your experience.
Yeah, I think on a general care basis, sub 20 beds are hard to get lenders excited about. On the specialist side, as Charles Phillips says, because they are holding up those smaller homes, very specialist, they're okay, but general is the banks are pretty shy in that space.
Okay, thank you very much. I'm conscious of time here because we're moving. It's now 11:50 and we were due to finish at 11:45. There are a few more questions in the Q&A section that we're not going to get to, but we promised that at the beginning of this we will answer all the questions and come back to you individually afterwards. So it's just down to me now to wrap up the event and to thank all of you for attending today, and also obviously all the speakers, John Harrison, Charles Davey, Hazel Phillips, and of course Charles Phillips as well. And like I said before, quality on Charles's section was a little bit poor. We'll make sure that we get that out to you as well as part of the after webinar information along with the recording. I'd just like to thank you all again. I'd like to thank my team in the background for getting this set up and for moderating throughout the day. And a recording will be below. Thank you, everybody. I hope you've enjoyed it. I hope it's been valuable to you all, and we look forward to seeing you again soon.